Welcome back to AC Spencer Trades. Today we are going for a good old whiteboard session, right? I'm going to be breaking down to you the main parts inside of ICT and how you can trade them. Now this is going to look extremely simple when we do it on the whiteboard, but realistically it's exactly the same thing when you implement it into the charts. You're just dealing with candlesticks rather than lines. But I'm going to break everything down for you in a way which is really going to clarify anything that you're struggling with at the moment. And if you've never heard of ICT and you've never traded it before, well, this is the perfect introduction for it. I always find stripping things back to the simplest form is actually the best way to learn. When you're trying to learn something on a chart, it looks really messy. Here on the whiteboard, it looks really clean, but it's exactly the same logic. It's just applied in a slightly different way. So once you've watched this video and you understand it, make sure you go and check out my ICT masterclass. There's another video on my YouTube. I'll put it in the description below for you, because that's going to then take everything that you learn from here and then you can go and implement it into the charts. And like you say, it's exactly the same. It's just obviously here we're going to be dealing with lines, and in the markets you're dealing with candlesticks. So without any further hesitation, let's get straight into the video and I'll show you exactly how I trade and how you should be trading ICT, because there's so much which comes under the ICT umbrella, but to be honest with you, so much of it is nonsense. You just need to strip it back to the basics. So first thing that we need to establish is what areas are we actually looking to take a trade from, right? Because this is one of the most complicated parts about trading. Well, it's not complicated, but it's something that everyone gets wrong, right? And you just need to understand this very basic thing, that higher time frames carry a much stronger bias than lower time frames. There's much more data which is included in it, so it, of course, is going to take priority. So first thing that you want to be looking at really is either the 1 hour chart or the 4 hour chart. You don't really want to be looking at anything else. The others are just noise, and it's completely irrelevant for areas where we actually want to trade from. So on the 1 hour and the 4 hour chart, we have got FVGs, okay? Fair value gaps, the gap between the first and the third candlestick. Now, the other one which I like to trade from is an order block, okay? Now, these are the only two places which I am looking to trade out of. If there's no order block and there's no fair value gap, I don't want to be entering into a position. It just doesn't make any sense to me. I'm not even looking at the chart anymore. I'll simply walk away and I'll come back the next day to take a look at it. So on the 1 hour and the 4 hour chart, you're looking for these order blocks and fair value gaps. You mark those up on the chart, and that is all you need to do on those higher time frames. So the next thing that you're looking for on the higher time frame are these liquidity zones, right? I'm sure you've heard of liquidity. Whether you understand it or not and understand where to find it is the big question, right? It's all good talking about it, but if you can't see it on the chart, it's not very useful. So what we're looking for here is higher time frame highs, lows, and then we're looking for session highs and session lows. Okay, these are the only 4 points which you need to be looking for in terms of liquidity levels. And again, that needs to be on the 1 hour or the 4 hour chart. So once you come into the chart, first thing you do is mark out the different areas where you want to be trading from. So fair value gaps and order blocks. The next thing which you want to be doing is marking out the liquidity levels, right? So higher time frame highs, lows, session highs and lows. Now, when you combine these together, your probability of creating a successful trade just completely skyrockets. If you're just trading out of a fair value gap or an order block, it's okay, but when you combine that with one of these liquidity pools, now you're looking at an A+ setup, and the chances of a reversal just completely skyrocket. So the way that you combine these together, if we draw this up on the chart here, so what we're looking at here, right, pretend this is the higher time frame, okay? So we're looking at the 1 hour chart here. So highs and lows, we've got a low here which has not yet been touched. We've got a high here, but it doesn't count because price has already ran through it. So that liquidity level now becomes obsolete. Then we've got this low here, we've got this low here, we've got this low here. These are all higher time frame lows that can then become a really nice level of liquidity. Now let's pretend that the Asian session started here. Okay, so this is now Asia low and a higher time frame low. So it becomes a double level, which is even stronger than just having one of these on their own, and price is going to be drawn towards that level. Now, the next thing which you're looking for is for price to come back into the fair value gap or the order block, okay? So let's pretend that this is an order block here, this is an order block here, and then we've got a fair value gap which is resting in here, okay? So we've got these three levels which we're potentially looking to take a trade out of. Now, when you see this, you're expecting price to come back into one of these three levels before we see a reversal, okay? So again, this is still remaining on the higher time frame. You don't need to change time frame just yet. Stick to the 1 hour. Don't even look at the lower time frames because you're going to get distracted. So now what we're looking for when we come to one of these areas is a reaction, okay? So that reaction, of course, we're expecting a reversal from here because the higher time frame is to the upside. We've come down, we've swept an area of liquidity, we've landed into one of our PD arrays, the fair value gap or the order block. So now the last thing that we're looking for from here is a reversal to continue up to whether that's US session high, whether that's London session high, either or, it doesn't matter. As long as it's a session high, even if it's not a session high, we know that there's liquidity resting there because it's a higher time frame high, okay? So once we've got this, once we've landed in this area, this is the point where we drop to the lower time frame. Okay, so now we're dropping into the lower time frame. So if you're trading on the 1 hour chart as your higher time frame, you want to be dropping into the 5 minute time frame as your lower time frame for this next stage. Then if you're on the 4 hour, you want to be dropping into the 15-minute time frame to do exactly the same analysis. So the concepts are exactly the same. Price is fractal, right? It doesn't matter what time frame you're in. The same concepts apply. Obviously, you're just dealing with a different time frame and your trade's probably going to last for a different duration of time. So with this, what we're looking at, price has now come back into this fair value gap after taking this area of liquidity, and we've still got Asia low which is resting below. So what often happens is people enter into a trade here, put the stop loss below the fair value gap and target back up to this liquidity pool which is resting above, okay? Which seems like a perfectly exceptional trade, right? Apart from you've got one issue. The biggest liquidity pool is resting right here down at Asia lows, okay? And this is where everyone gets trapped. So what we see from here normally is a reaction from here, then a consolidation, then we see the next move down, and this is where everyone gets stopped out, loses faith in their strategy, gets in a strop, and then starts trying to short the market because they think they've got their direction wrong, okay? We've all been there, we've all done it before. But this is the leg down, which is very, very important. And this is the leg down where the money is made. So on this next leg down, what you're looking for is a fair value gap, okay? So this is on the 5 minute or the 15-minute chart, depending on your higher time frame. Once you see this fair value gap get created, what you're looking for is an inverse of this fair value gap, so price disrespecting that level. And then this is another mistake people make, is now they want to start going long here, targeting up to there and putting the stop loss below the low. Wrong, because you've got no confirmation. This inverse fair value gap in here has just been disrespected. So why do you want to trade out of a level which has just been disrespected? It just makes zero sense at all, right? You want price to show you that this is now a level which is respected and that we can trade from. So the last little step from here is coming back down to this inverse fair value gap, then moving from the 5 minute into the 1 minute, or from the 15 minute into the 5 minute. So once you see this pullback to this level on the 1 or the 5 minute chart, all you need from there is a nice engulfing candlestick of the previous candle or a piercing pattern, a dark cloud cover pattern, and then that becomes your entry point, okay? So you're entering into the market here on this candle close once we've had the rejection from this inverse fair value gap, because price has now told you this is a respectable level that we're happy to trade from. Stop loss can then come in tighter below this inverse fair value gap, and then your target back up to this liquidity pool resting above, whether this is a session high or whether it's just a higher time frame high, that doesn't matter. That it becomes your target, and that's where you want to be taking your profit. If it's a higher time frame high, that's great. If it's a session high, even better. It just becomes a much better pull on the markets, and it's more likely to revisit that level. So the last thing that I want to go through then is just the checklist that I use personally in order to actually get into the market here, because I've broken down everything for you here. And it looks complicated, but it's really not complicated. So I'm going to write you out the checklist of exactly how I enter into these positions. But before I do that, make sure you hit subscribe, because I'm trying to simplify trading for everyone. It does not need to be complicated, and that is my job, is to simplify so that everyone can do this. So my checklist, exactly how I trade ICT on a daily basis, which generates me a serious profit. So first thing I'm marking up is higher time frame, highs and lows. Second thing I'm marking up is session highs and lows. Okay, once I've got those, I understand exactly where my liquidity pools are. Third thing that I'm doing is I am marking up the higher time frame, fair value gaps and order blocks. Okay, and that is all that I need to do in my higher time frames. Now the next stage, so this is here inside of the 1 hour. Then this is moving into the 5-minute chart. So I'm waiting for a pullback to one of my PD arrays, okay? So pullback to PD array. Okay, once I see this happen, I'm looking for the liquidity to get swept around the area of the PD array. So liquidity sweep. Okay, once I've seen that liquidity sweep, this is the point where I'm expecting price to reverse. But of course, we don't want to predict the market, we're waiting to react to the market. So I don't want to do anything yet until I see a 5-minute fair value gap get created. And that wants to be created on the move down, which is taking the liquidity, okay? So that is very important. The fair value gap must get created as the liquidity gets swept. Once I see this happen, I want to see the 5-minute fair value gap go into an inverse fair value gap. Okay, so that consists of a 5-minute candle close, closing above that fair value gap, inverting it, okay? Once I have seen that, I move down into my 1-minute time frame. So this is the 1 minute. And all I'm looking for here is a pullback to the IFVG. And then my entry becomes a 2 candlestick pattern. For me, I like to see an engulfing candlestick. Piercing and dark cloud cover are fine. Some of you may find that you get on with that a little bit better because you can enter more trades. Personally, I like less trades and more higher probability trades, which is why I like to go with the engulfing candlestick pattern here. But the choice is entirely up to you, right? So this is my exact checklist, which I go through every day when I'm trading the US session. So please go and test it out, see what you think, give us a thumbs up on the video, hit the subscribe button, and wow, I'll see you in the next one.